Hi everybody, Mr. Farmer here, and welcome again to AP Macroeconomics. So today we're talking about the income approach to calculating GDP. On our route to it, we're also going to look at some other national accounts, national income and net domestic product. Now, one thing is I'll keep saying gross domestic product here. Actually, it should be GDI, gross domestic income, because we're using the income approach. It is the GDI or GNI's gross national income. We'll use GDP and GNP just for the record, but they're for our purposes interchangeable, just in case you do run across that. Before we get started here, I like to kind of make sure we understand something. Just like the amount of money spent in the goods and services should equal the amount of money spent in the factor market, okay, back from the circular flow, that's the idea behind the amount of money spent on the goods and services on the expenditure approach should equal the amount of money that is spent on the production of these things, which is the income. Because if you've made the income, you can then spend that money. So this is why the two approaches should equal each other. In order for households to spend the money, they needed to have made their money somehow, hence the income. So that's the idea behind it. And so if we keep track of that, how did the households make their money? How did the businesses make their money? How did the government make their money? Then we can see where it got spent. So that's what we're keeping track of. So as we go along, kind of keep that in mind. Here we go. So the first thing is we're going to get to the national income, which is the income earned through American-owned or whatever country you're in. It's based on that domestic income owned resources. One thing to note is this is based on nationality. And so we're going to have to switch some things. So even though we have things like McDonald's, which is a US-based company, McDonald's is all over the world. And so all the incomes across the entire world that are McDonald's, let's just keep it simple and say it's McDonald's US and not worry about McDonald's Europe or McDonald's Asia or McDonald's whatever else. Let's just say it's all one big company that all belongs to the United States' national income. GDP doesn't care about nationality. It cares about where was it made. So we will need to switch some stuff later. Anyways, the national income is going to consist of W, R, I, P, R, and T, or Whipper T. And you can try twerp, but it doesn't really work out because you do need the P and the R in the right order. Okay, but there's no great way to remember this one. So here's the long of it. Okay, so the W is the wages, the labor income. This is the total salaries, wages, benefits, pensions, and Social Security contributions. This is the main way people make their money. The second one is R, which is rental income. So rent is simply the total income earned from property ownership. This is not just the apartment or the rental house. This is anything that you rent. It could be the tractor that you rent out from your company. It could be the stove that a restaurant rents or leases for their startup. Okay, it's definitely more than that. How about the interest? All interest that you earned. If you invest your money by supplying capital, meaning if I put my money into a bank, I'm supplying financial capital. In return, I get interest back. So even though that's an intermediate service good, no goods or services are being created during the time, we're not worrying about that. We're trying to figure out if I've made that much money, I can then spend that money on a final good and service. That's the concept here. So how have I made my money? So how do most households make their money? Through wages, some through rent, some through interest. How about businesses? How do they make their money? Well, we have two different categories. Proprietor's income, that would be sole proprietor and partnership. And then we're also going to have corporations. Okay, and so this is going to be the two different sectors we're going to talk about. So the proprietor's income is non-incorporated, and then we're going to have incorporated as well. And so that's going to take care of our businesses. And the last one is, how about government? How about them? So for government, this is the sales tax and business property taxes and license fees. So that's one we're going to include. What about personal or taxes? That's like the biggest portion of the taxes. Well, this is where it's a big distinction. The wages is pre-tax. Okay, we would call personal income, not disposable income. So this is going to be the gross income, meaning pre-tax dollars. And so just like double counting, we don't want to double count the same good or service twice. We don't want to count the same income twice also. And since that money has already been included in this pre-tax wages, we're not going to count it a second time underneath the government. So yes, personal income taxes are accounted for already. Okay, so again, we gotta keep that in mind. So this is how it looks. Compensation of employees, that will be our W, plus rents, interest, proprietor's income, corporate profits. So we add these two together to get business incomes. And then taxes on production imports. It's kind of the catch-all of, do we not deal with anything? We add that all up and we get the national income. Again, the final thing is gross domestic product, so we're not quite there yet. So let's break these down a little bit. Compensation employees, the wages, this one's pretty straightforward. Wages and salaries by businesses and government to their employees. Again, that's pre-taxation. Rental income, income received by the households and businesses that supply property resources, rents, or leases. Interest, money paid by private businesses, banks paying the interest they owe on the savings, whatever else it is, to the suppliers of money capital, financial capital, just money you invest. Interest households receiving from savings items such as certificates of deposit, blah, blah, blah. So these ones are pretty straightforward. They're going to be, like you saw, just line items on a data table. So we're not going to do too much with this. Businesses, though, we are going to look at proprietor's income. That one's also a line item. Consists of the net income of sole proprietorship partnerships and other unincorporated businesses. Again, just a pretty straightforward one. But how about corporate profits? Like you saw in the previous slides, corporate profits was just a line item given. However, sometimes it includes three separate things you have to keep track of. So corporate profits. Okay, one thing to realize is we only want to care about the corporate profits because how about the money they made and they spent on their workers? That was included in the wages. How about the money they spend on the capital? Well, then that would be the income of the other business that produced that good. So we only look at the profits because all the other money they've made has been filtered out in some other aspect, in some other way. And so corporations only pay corporate income taxes if they have made a profit. If they break even, they do not pay anything in corporate profit or corporate taxation. They might still pay something else in taxes, some other whatever else it is. But corporate taxes are only on profits. And so if we're trying to figure that out, we take that into account. It's tax on corporations that flow to the government. Next one is dividends. This is an optional thing for corporations to do, but this is that they can, out of their profits, they can give kind of thing bonuses to their stockholders. And so this is, again, up to their discretion. They don't have to do this, but it's kind of a loyalty program. Hey, thanks for hanging in with us. Here's whatever else it is. Here's 25 cents per share, which isn't much unless you realize some people might have hundreds of thousands of shares. That 25 cents then adds up quite a bit. And then what's the last part? So you paid taxes, you gave it away, or you didn't spend it. It's a savings for later use. You undistributed corporate profits retained for earnings. And so these three areas are going to make up whatever that profit is for the corporation. So we have proprietor's income and corporate profits now. Tax on production imports, it's the general sales excise tax. Again, it's the catch-all for everything else. Why add this? Because we haven't accounted for this in some other place. We account for corporate taxes, we account for personal income taxes, but there might be some that we haven't accounted for. So again, if we're trying to figure out how much money people have, we need to figure this out, and that does include the government as well. So here are again, and again, all the income that flows to American or whatever country you're in, supplied resources plus tax on production imports, because again, that is part of the government income. But we eventually need to get to the GDP, which is going to eventually be this $12,487. So we're still a little short. So let's do some more with this. So from national income, we add in statistical discrepancy, which is just going to be given to us. Statistical discrepancy is the variance, the percent error, if you guys did chemistry. Okay, how much do we potentially miss by? Okay, we might have missed by a little bit. And the only thing we subtract out in the entire equation is going to be the net foreign factor. You subtract that number out. So why the net foreign factor? I liken it to the net export. It's not the same thing, but the reason why I do include it in that way is it's the thing that deals with the international. So again, national income only includes the national income, the income produced by U.S. nationalities. Okay, as far as that McDonald's over in Europe or Asia or wherever you're talking about. Okay, that's all part of the U.S.'s national income because McDonald's is the nationality. Here's the dilemma. That money has not flown to the United States. It stayed in whatever area it was in. So the net foreign factor does is it corrects for that. So it takes the Toyota, okay, that was made in the United States and the income that was produced by that in the United States, and that adds it into the United States', and then it subtracts that from Japan's. Or from McDonald's, it subtracts all those incomes that were made outside the United States. It subtracts that from the United States' national income, and so it corrects for that scenario. So now all the incomes that were produced in the domestic borders are where they should be. That's what the net foreign factor does. Statistical discrepancy is just because there's percent errors. There's a lot of variations, and so we do check on this. So now we're at the net domestic product. So we went from national income, we add in statistical discrepancy, we subtract out net foreign factor, and we got net domestic product. So how do we go from net to gross? Well, it's the same thing as with the gross domestic private investment. Consumption of fixed capital. Is that accounted for? So the idea is that the gap between the gross and the net, just like in the business, is has consumption of fixed capital, has depreciation been accounted for? If the answer is no, it has not been accounted for, it's the net domestic product. If it has been accounted for, you've now figured out the gross domestic product. Or again, because we did the income approach, gross domestic income. So just a reminder, it's the idea of allocating costs over a period of time, the idea of the roof scenario I gave from last time, where over 15 years you have the cost, the depreciation of the roof by $1,000. If you want to go back and look at the expenditure approach video, and I talk more about this. So here's the entire equation broken down. So we start with wages, interest, rents, proprietor's income, and then corporate profits. Corporate profits is sometimes corporate income tax, dividend on distribution of corporate profits, and then tax on production imports. You do all of this, you get the national income. You then subtract the net foreign factor, add in statistical discrepancy, and get the net domestic product. You add in depreciation, and you get the GDP. So that's the entire equation. So I'm going to pause here for a second so you guys can look at that, or just pause the video so you can look at it a little bit more. But that's the entire thing. So here is a circular flow, which is really overwhelming. It's actually from the McConnell-Brew textbook. I know you can find the image online, or again, you can just pause this, page 115 of the 17th edition. The reason I like this is it really fills in what the income and the expenditure approach really looks at. You can see up top the orange is the expenditure approach and the green is the income approach. So we have households, businesses, government, and then international. That would be the expenditure approach. And then when you add all those flows together, you get the GDP. So what's the GDP? For the income, it's wages, rent, interest, dividends, proprietors, corporate income taxes, undistributed corporate profits, tax on production imports, consumption of fixed capital. It doesn't include the statistical discrepancy, but that would be on there. Okay, so what's included in the net domestic product? Everything except for consumption of fixed capital, which again is a payment towards businesses to help fix things. Okay, or payment for later use. Okay. And then we go, okay, what about national income? You can see national income, we have added in net foreign factor. So to go from national income to net domestic product, we would have subtracted out that flow to get the net domestic product. Okay, so for national income, how about personal income? Well, then we include the wages, the rents, the interest, and the dividends. All those flow here. Everything else, hey, that's a business. That's a government. There we go. There's Social Security contributions. Okay. How about personal income? Some of that goes towards taxes, personal income taxes. That's why we didn't include it before, because it's already accounted for. That's why we didn't add it up here again. So we have our disposable income, the amount of money we actually have access to as households after we paid our taxes. So households then go spend their money. Some of it's going to flow into savings. Again, that's going to be a later conversation with financial investments. Okay, government, how do they make their money? Well, through corporate income taxes, through personal income taxes, okay, and some of that flows back out through Social Security contributions. Okay, and they can go spend their money in businesses, blah, blah, blah. So if you actually try and look at this kind of individually, section by section, it can actually help you figure out, why do we talk about this stuff the way that we do? What have we actually accounted for? If you look at it all at once, it is overwhelming. But hopefully, if you kind of break it down, it does help you understand the income versus the expenditure approach. So if you want a good look, go to wikihow.com, calculate GDP for the income approach. And again, today the focus on was, how do you do the income approach? And hopefully that helps balance out the expenditure approach. We do focus significantly more on the expenditure approach, C plus I plus G plus net exports. That is going to be the main one. We do want to know about the income approach just to make sure we can kind of do a checks and balances on our numbers. Until next time, bye.